The artificial intelligence industry is experiencing unprecedented growth, with companies investing hundreds of billions of dollars in infrastructure. But a troubling pattern is emerging that has analysts warning of a potential bubble. The concern centers on what experts call circular deals, a web of interconnected investments where the same money appears to flow in a loop between a handful of powerful companies. On the surface, OpenAI appears to be riding a wave of massive investment and explosive growth. Billion-dollar deals, partnerships with tech giants. But look closer, and a troubling pattern emerges. Here's how it works. Microsoft has invested roughly $13 billion into OpenAI. That makes them OpenAI's largest backer. But Microsoft isn't just an investor. They're also OpenAI's biggest customer and their primary cloud infrastructure provider through Azure. So the money Microsoft invests? A significant portion flows right back to Microsoft as OpenAI pays for cloud computing services. This is just the beginning of the loop. Now, let's add more players to this puzzle. SoftBank invests in OpenAI. OpenAI then spends money with NVIDIA for chips and computing power. SoftBank? They have deep ties with NVIDIA too. NVIDIA invests up to $100 billion in OpenAI. OpenAI uses that money to buy computing power from Oracle, which spends about $40 billion purchasing chips from NVIDIA. Meanwhile, NVIDIA also holds stakes in CoreWeave, a cloud computing company that provides AI infrastructure to OpenAI. And the circle continues. Each company wears multiple hats: investor, supplier, customer, and partner, often simultaneously. In October, OpenAI announced another major deal with AMD, NVIDIA's direct competitor, potentially taking a 10% stake in the chipmaker in exchange for purchasing their chips. These partnerships involve staggering sums. Oracle and OpenAI have committed over $3 billion over 5 years as part of the Stargate project, a $500 billion infrastructure initiative also backed by Japan's SoftBank. NVIDIA itself has grown to a market valuation of $4.5 trillion, largely on the strength of AI chip sales. Together, these deals have helped push U.S. stock indexes to record highs. But analysts are increasingly concerned that this circular flow of capital creates what one called a mirage of growth. Wall Street research firm New Street Research estimates that for every $10 billion NVIDIA invests in OpenAI, it receives $35 billion back in chip purchases or lease payments. That's roughly 27% of NVIDIA's annual revenue. Stacy Raskin, an analyst with Bernstein Research, wrote that these deals clearly fuel circular concerns, while Seaport Global analyst Jay Goldberg said they carry a whiff of circular financing and represent bubble-like behavior. The comparison to past tech bubbles is hard to ignore. When the same dollars circle between the same companies, it looks like massive economic activity. But in reality, it's more like moving money from your left pocket to your right pocket and calling yourself richer. Second, it concentrates risk. If one major player stumbles, the entire ecosystem could collapse like dominoes. These aren't independent companies spreading risk. They're interdependent partners whose fortunes are tied together. Third, it raises questions about true market value. The economic stakes extend far beyond Silicon Valley. According to Oxford Economics modeling, tech investment has become so dominant that it accounted for 92% of U.S. economic growth in the first half of 2025. Without tech investment, U.S. GDP would have barely grown at all. This means the entire American economy has become vulnerable to any downturn in AI spending. If a tech bubble bursts, Oxford Economics projects U.S. GDP growth could fall to 1.7%, with ripple effects hitting economies from Mexico and Canada to Taiwan, South Korea, and Malaysia. Not everyone sees disaster ahead. None of this is illegal. This is how modern Silicon Valley often operates: strategic partnerships, vertical integration, ecosystem building. Some analysts argue that circular investing is simply how business works, and that AI will ultimately deliver transformative value. OpenAI CEO Sam Altman has acknowledged that investors may be overexcited about AI, but maintains the technology represents the most important development in a very long time. Even skeptics note that the current bubble risk appears more contained than the dot-com era, when valuations were even more divorced from fundamentals. What makes this moment particularly precarious is the concentration of players. The AI boom relies on just a handful of companies turning to one another for capital and computing power. As one analyst put it, if any weak link emerges in this tightly wound circular economy, it could threaten the viability of the entire industry. The question facing investors, policymakers, and the broader economy is whether we're witnessing the foundation of a transformative technology revolution, or inflating a bubble that could rival or exceed the dot-com crash of 2000. The answer may determine not just the fate of tech companies, but the trajectory of the entire U.S. economy. For more news and updates, keep watching LiveMint.